Good evening. This is Ken Long from Tortoise Capital Management with a case study that's going to look at a volatility trade framework where we prepared on February 19th for a trade on February 20th, 2013. We're going to be examining what being prepared looks like, then how we find and then follow the market intraday based on that trading framework, and we adapt and respond to the price action that we see. So it begins with a look at the market health check. This is daily charts, about 4 months. 30-period Bollinger Band is the thick blue river in the middle, plus or minus 1 standard deviation. The floodplain, as we think of it, is the plus or minus 2 Bollinger Band with the 30-period look back. The orange ribbon is a 2-period Bollinger Band, which in my view, represents the real price path. I think it makes a better candle than a candle. We've got Williams percent R10 down here to look at short-term overbought, oversold. We have a percent price oscillator with parameters 10, 20, and 8 to give us intermediate term signals. We have the ADX up top as for measures of trend strength. The vertical blue lines are 10, 20, and 30 days worth of look-back period. The thick black line in the middle is a 30-period regression line, minus 1 day, so we end it with yesterday's price. The outer lines form the RAF regression channel created by the maximum excursion from the regression line during the look-back period. You can see how very narrow this is right here. We're in a bull quiet mode based on our market classification. And so what we had is like 30 days of uninterrupted, very quiet, steady moves up. You can see the 30-period regression line slope is plotted here in the background, and right around here, first week of February, that achieved a new high, and then slightly weakening here in this little pullback section you see has caused the 30-period regression line slope to actually decay a little bit. It's still very positive. The zero line is this dotted line. So this is still an upward slope, as you can see, but that actually suggests that there's the beginning of a weakening tendency, the same weakening that has caused the plus DI in ADX to actually decay a little bit, and then for the ADX line to flatten out. It's just very hard for the market to continue up unadulterated like that for this long. So it's been quite a nice long move. Now the red area is the 200 period moving average, and that's the boundary there of the 200. You can see how the river and the floodplain have pulled away from that 200. These horizontal red lines represent previous levels of support that were once resistance, and those become profit targets on the downside should the trend that's producing this nice tight channel break. Those are start to become the areas we're looking for price to get to in a hurry. So we're looking at a bull quiet market that's been marching up, and our observation was everything is so universally positive and extraordinarily quiet, and at the end of a relatively long run, that we wouldn't be surprised for shock and awe to happen to the downside. And if so, our plan usually is first to look at the volatility ETF, which at this time is actually very quiet. So the next thing we look at is to go drill a little deeper into what we call the market mosaic from the daily trading plan. We're looking at, here's that 30-period regression line over the last 30 days. You can see prices right back on the regression line. Even though there was a slight breakout, it is right back on normal. This is the time series on the slope of that regression line, which we use as a market indicator. And the black line is the 10-period moving average of that slope function. The horizontal black line is the average of the last 180 days, and plus or minus 1 and 2 standard deviations form those boundaries. And what we've noticed is that in about the past 90 days, the regression line has improved and made a 1, 2, 3, a little more than a 3 standard deviation move off the low, which corresponds down here to percent stretch above the 200. And you can see that the market has made almost a 12% move off the last time. The last 2 times it has dipped below the 200 day moving average. So it's been an extraordinary move, and using the same logic here, that's been a 1, 2, 3, 4, almost 5 standard deviation move in the last 90 days. So that's really kind of an extraordinary move. Now, you notice that the slope of the 30 period has started to decay here, and it's gone below the black line. This is a 30-day zoom in of that 6-month chart. And so whenever the crossover occurs at a point outside the plus or minus 1 standard deviation, then we consider that to be an early warning to a potential turning point. And so this is just warning us that we may be near the end rather than the beginning of this bullish move up. And so this makes us prepared to trade to the downside, because if it does that, it's going to be a sharp, shocking move, and we want to be able to participate. The next thing we pull off the daily charts are the what we call the swing Z, or the Z scores of swing time frame gains for each of these symbols that consider the last 5, 10, 20, and 40-day holding periods. Now what we do is we go back 10 years and we compute all of the returns for each of the 40-day holding periods of the last 10 years, and then we compute the maximum, the min, the average, and the standard deviation, and then we determine the Z-score for each of those time frames based on today's holding. And we score it in with green, like an XLP, has had over the last 40 days a 1.35 standard deviation favorable move. So it's been an exceptional move over the last 40 and 20 days in XLP, the sector spider for discretionary. Similarly, we have Latin American emerging markets and materials, and the VIX all are in yellow, so they're below average. And you can see the VIX over the last 40 days is actually almost a full standard deviation down. So it's been negative over the last 5, 10, 20, and 40. So when it's that washed out, it's been extraordinarily quiet in the market, and conversely, that sets the conditions whereby a surprise increase in volatility can happen fast and provide a very favorable one-day trade that could grow into being a swing trade. Well, what ends up happening on the night, this is from the 19th of February. The 20th of February was this kind of day. It was a sharp move down, big red candle. It rejected that swing high at 152 and it started heading down. And it ends up right on one of those red lines of support that we looked at on the market health check. And that kind of a move was a 8.5% move in the VIX, and therefore about 17% in the double VIX UVXY. And that move was kind of extraordinary on a 5-day basis. The VIX now is at a positive 1.17 on the short-term holding period, and what were negative Z-scores here on the 10 and the 20 have turned into a positive, and the 40-day holding period Z-score was cut in half, and so that's day one of a sharp potential move, and therefore makes us interested in this going forward on a swing trade basis. Now, the other thing I'll point out from the daily trading plan from February 19th, 2013, is that when we looked at the ETF 30 tactical summary, we use this to summarize a variety of swing trade patterns and did they fire or not. In this case, you can see that 3 fired on the 5-day down patterns. That was gold, silver, and the agricultural ETF. The ones I want to highlight here are the max pain range compression, and the auto framer reward to risk ratio, which is a standard way we use to compute reward to risk ratios based on common swing trade parameters. It uses yesterday's high plus a nickel as the mechanical entry, and yesterday's low minus a nickel as the standard risk unit, and then computing the reward to risk based on that risk unit on a retest of the 10-day high. And then we highlight those that are better than 2 to 1, because simply based on trade location, they now offer the opportunity to have a favorable reward to risk and can be traded on that basis. And so the 5 top candidates for max pain range compression, that means the greatest loss over the last 10 days divided by the smallest range on yesterday's price, gives us both important qualities: maximum pain, that's the sell-off, and then range compression, which is small range. And that gives us minimal amount of information required to establish a new trend. So we look at VIX, symbol VXX. That's the number one range, max pain range compression candidate. It has a favorable reward to risk ratio of 3-to-1. The symbol is highlighted red, meaning that it was it was an extraordinary percent loser on February 19th. It actually closed with an RSI2 value of 1, meaning it was washed out. And then these are the price change percentages over the last 1, 10 days, 1 month, 3 months, 6, and 12 months. Highlighted red means that among the ETF 30s, this has been an extraordinary relative loss. And so on February 19th, the VIX lost 4%. Over the last 10 days, it's down almost 15%, and so on. And this section here shows how far out of the previous X day holding period it had failed. So it was almost 30% lower than the previous 10-day low based on what that 10-day trading range would be. So by all measures, VIX had been extraordinarily washed out at the tail end of a large quiet move up like this in SPY. That's not unusual, and that actually sets the conditions whereby a favorable reward to risk trade can be set up, and we will be prepared for that during the day. So let's see how that was the mindset we had going into February 20th. We knew which symbols were the strongest, things like XLP that are already strength leaders, or all these in white in the U.S. We'd been looking at the mid caps and then the small caps, MDY and IWM respectively, because they had the strongest Z scores. That's where the relative strength were. And so if there was no sell-off on the 20th, then we'd be emphasizing those targets as the easiest way to play a continuation pattern in relative strength. But we're prepared for the counterfactual, for the trade in the other direction, if we see that kind of information during the trading day, because that first move away from the previous strong trend is often the most lucrative trade to make. And so we open up now. We're looking at intraday on February 20th, and these are 3-minute bar charts, and using the 30-period Bollinger Band plus or minus 1 as the river, with the Bollinger Band median as that red line. And now we're looking at TNA, which is the triple leveraged Russell small cap, and then UVXY, which is the double leveraged VIX ETF. And then the blue line is where we start stalking it. That was where the market opened and the market opened here. And so we start initially looking at TNA to trade. It opened near the close from the 19th, and then started selling off through the river. Found some support here at the bottom of the river, and then based on that, I elected to play this as a rebound from a known support level at the bottom of the river. Why? Because the river was up. It was finding support here where the VWAP closed yesterday, and so this looked like a natural place to find support. And so we make our entry RFA, that's ready, fire, aim. And we're looking at 2013-0220, so that's February 20th, year 2013 in TNA. Our entry in the green circle here is at 83.70, and we're playing a 30-cent stop down here at 83.40, right in here. It almost immediately fails. It goes up one more bar and then starts selling off. And then when it exits the river, and the ribbon exits the river. That's the 2-period Bollinger Band intraday also. That's a sufficient move to get out, and so we exit almost immediately at 83.55. That's minus 0.5 R. That causes us to start stalking in the stop and reverse trade into UVXY. And while this trade is happening here in the yellow space, that correlates to this space here. As TNA was failing, UVXY was actually failing and found support down here at the Bollinger Band mean. These aren't perfectly correlated. You can see that they're both losing, but while IWM starts failing, UVXY actually doesn't even cross the Bollinger Band mean. The ribbon does not accompany this bar tail down, so that sort of tells you that's a low volume anomaly. And the river continues to roll up. It finds support at its own VWAP. Notice the 30-period regression line here is out of the river and never even budges during this sell-off. And so that makes this equal to our definition of the beginning of trending behavior, and sort of reinforcing the longer term trend. The river is up, 30 period is out of the river and up, and now price is leaving, so I enter here at 9.07 using a 10-cent stop here, which is down at the Bollinger Band mean. Now that's a pretty tight stop in a volatile instrument, and so you might be willing to use a 20 or 30-cent stop in here at the logical places shown here by the dotted lines. However, this one continues to take off, and now the ribbon has left, and now the 10-period regression line has left, and now we're up at 9.19 with an R in hand, and things are moving well, and so that's where we would move the stop here to the edge of the river, and now we're going to be locked in, and this will only be a winning trade from this point on. So let's follow that trade a little bit longer. It moves up here to 9.30 and then up into 9.31, and then it goes into this consolidation pattern, shows a little weakness. We get this spike here, which is unaccompanied by the ribbon, and so that's sort of an indication of a failed breakout. And then we get a lower opening in this next red bar, and it starts selling off. And so as price and the ribbon are approaching the 30-period regression line, and the 10 is rolling over, and we see the exhaustion bar and a red bar here, that's sufficient for us to exit. So we get out at 9.30, and on an initial risk of 10 cents, that's a 2.3R. Almost shortly thereafter, we get that regression line crossover signal. When that happens, our expectation is a price target or a price movement back to the Bollinger Band mean. In this case, it doesn't do that. In fact, it just holds, the price holds at the edge of the river. This is a continuation pattern, so we start stalking it again. This is the exit that we made right here, but this is a new chart. So now price holds at the river, the ribbon holds, both regression lines and the price are out of the river and everything pointing up. That's the definition of beginning of trending behavior. So we go ahead and re-enter almost immediately at 9.31, giving up 1 cent in the process, again with a 10-cent stop down here vicinity, the Bollinger Band mean. It chugs along a little bit, never really breaks out and goes, and then we get the 30 and the 10 regression line rolling over. Price and the ribbon re-enter the river, so we go ahead and just take that for a fractional gain and exit at 9.38 for a 0.7R. And now we notice, we're heading into lunch, and there was failure to follow through. So that's a good time for us to get flat, raise capital, reset our brains, and then be ready for the next tradable move. Well, during the lunch hour, this really just consolidates into a sideways quiet channel, by which I mean the 30-period Bollinger Band mean is flat. The range of the river is narrow, so it's sideways and quiet. And then the price and both regression lines are inside the river. That's the definition of sideways quiet channel. And then we're looking to play for the breakout with a stop on the other side of the river. It first happens here, and so we take our entry at 9.38, which is where we exited before, so we don't lose any opportunities by being prepared. And then we're going to use a 10-cent stop on the far side of the river. Price and both regression lines leave the river. We get a little spike up, but then it almost immediately fails as price crosses back over the Bollinger Band mean. Take my exit at 9.35, losing 3 cents for minus 0.3R. Price comes out of the river, the ribbon comes out of the river, but I notice that the ribbon is not accompanying this big spike down, and that looks like an exhaustion bar or maybe a false breakout to the downside. And because the market was weak and UVXY had been strong, elected to only play the long side on this one. And so then about 6 or 9 minutes later, we get price and the ribbon leaving the river. The 30-period regression line is rolling up. The 10 has rolled over and crosses the mean and is rolling up. So we go ahead and re-enter at 9.42. It takes off really and never looks back. We've got trending behavior again now that price and both regression lines are out of the river. When it clears the previous swing high here at about 9.50, go ahead and take the next entry at 9.57. That's an R in hand with momentum, new high of the day, and then boom, it's off and running. It gets up to 9.89. There's a little short pullback. Never really fails, so we're in the 10-period regression line doesn't even roll over, so that doesn't chase us out. And then when it resumes almost immediately after, clears that hump, we get a third entry at 9.89, again with the 0.15 stop in this case. It explodes up to about 10.10. Then we get a sharp reversal with a large range red bar. The ribbon has started to go sideways. The ribbon's mean is sideways. You can see the 10 starting to decay here. And go ahead and exit at 10 even on all three positions. Enter one at a time, but exit all at 10. And we chalk up 7.5R. Now on this one, I had a meeting to go to, and so that's where I got flat for the rest of the day. And but shortly after here, this thing finds support at about 10 and runs up to 10.30. It was very tradable with an entry at about 10.06 after it clears the previous swing high of the ribbon. And so there had been an opportunity maybe to squeeze out another 1 or 2 more R before the end of the day. And so when the smoke clears, we end up looking at about 10R in this one, all based on a volatility trade, which we were prepared for because of the preparation that we'd done the day before by examining market classification, market conditions, knowing our price points, and having a strategy for a market that's going up. In other words, stay with the strong. That had been the small caps and the mid caps. As you saw in TNA, we elected to go with the small cap because that had been the risk on trade of the last week. And so when it started to find support where we expected, that's what we went with. But when it fails, then we're ready immediately to switch our orientation to the risk off trade, and then and our target was volatility. And so we get rewarded in a series of trades, each one based on reward to risk ratios that have measured entries and stops and exit points, and informed by our regression line crossover and sideways quiet channel lens. So that's our framework for decision making that incorporates both intermediate term swing patterns and market classification, and intraday technique to find improvements on entry points and find low risk trades throughout the day. So that's today's trade of the day. Thanks for your kind attention. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.